Forget on the Lal Street, the Nifty has given up the 10,000 mark. The Sensex has lost over 400 points and bank stocks have led the fall. Is this the start of a correction? And it's not just equities, because if you take a look at the currency market, the rupee has hit its lowest level in 6 months and bond yields are also soaring. That is what we're going to be discussing here on today's Market Roundtable. Joining me, our stocks editor Anuj Singhal and our commodities editor Manisha Gupta. Also with us, our banking editor Lata Venkatesh. But Anuj, to you first, the sharp fall that we've seen our markets today. How concerned are investors with what has happened on the Lal Street this Friday afternoon?
Well, the key point today was that the Indian market fell under its own weight. The global markets were doing fine. In fact, India was the worst performing market. I think the genesis of today's fall is in what happened yesterday. The way the currency fell yesterday, and today also in the morning that continued, though towards the end that recovered. But the larger point here is that has that changed sentiment a bit? The market is worried whether the macro is going for a toss. So far, the big hope was that while the micro hasn't done well and the earnings haven't picked up, at least the macro is in place and it's a matter of time before earnings growth will pick up. Now, are we starting to look at the macros also, with some bit of suspicion? I think that's the market's bigger problem. But having said that, Indian market is a peculiar market. It goes up like this and it falls down also like this because you create a lot of leverage positions, and that's why what you see is a lot of unwinding as well. For example, this year the Nifty is up 22%. That's a lot of move for an index. The mid cap is up 29%. The small cap index is up 36%. And if the small cap index is 36%, you can imagine what would be happening to some of the portfolios. I mean, look at some of the stocks. Indiabulls Housing Finance, for example, is up 92% this year. L&T Finance is up 133% this year. And these are large cap stocks that I'm talking about. So the short point is that the market was heavy. It needed some trigger to correct. Maybe it's got one. Who knows where this market goes, but falling under its own weight, maybe some more correction to go, but the consensus is that that correction would be a healthy correction.
All right, Anuj, many thanks for joining us. The markets perhaps grappling not just with global issues, but also with local issues. Anuj, appreciate you joining us. Now, I must point out that it's not just India. Many equity markets around the world are at record highs and close to record highs. So the question now is, are these valuations sustainable? And that's the question that we've been putting to market makers when we speak with them. And a lot of people do believe that perhaps the earnings growth and the valuations are not justifiable. But then there's the other camp that believes that in the long term, it all starts to add up. But speaking to Lata on the sidelines of the JP Morgan Investor Summit, Jamie Dimon, one of the world's most respected bankers, says that global growth will justify the market valuations. Listen in.
See today in the world is almost, it's not synchronized, but kind of growth in Japan, growth in China, growth in Europe, growth in the emerging markets, growth in the United States. Brazil's gone from -4 to going to be positive here. That's a good thing. So if you're in the emerging markets, the most important thing is that you have growth. The world has synchronized growth. If it's followed with some good policy, which you're doing in this country, which they're talking about doing in France, competitive tax reform in the United States, if those things happen, you hopefully have more growth in the world, and that will justify valuations.
Well, that's Jamie Dimon saying that growth will justify valuations. And it is important to note that as far as the global recovery is concerned, it is now starting to gather momentum and get legs. Dimon hopeful that growth will justify valuations globally, but even his India and emerging markets colleagues believe that the Lal Street back home is a tad expensive. Bharat Iyer called India's valuations demanding, and JP Morgan's emerging markets research head expects some money in India to move out to China. Take a look.
I guess what has happened is we are at that stage where, valuations are a trifle demanding at 19-20 times forward earnings. And we're still going through an earnings downgrade cycle. And we must appreciate that, India is actually quite a unique case in the context of emerging markets on earnings. While for the rest of emerging markets, we're seeing earnings being taken up, India continues to see a fall. So, it takes very little to create a little bit of nervousness or a little bit of profit taking. And I think that's what we're seeing.
India has been, I would say, within the narrative of EM growing faster, delivering higher yields, having central banks that up until recently, have been cutting rates, India was right on center of that story. Now, we have had, of course, a couple of things happening recently that were India-specific, so in which India started to deviate from the EM narrative. One is that we had some disappointment with growth, and we were ourselves forced to downgrade the full-year growth forecast. So while we are upgrading many other countries, we downgraded India.
Let's go across to Manisha Gupta now. Our currency and commodities editor joins us. Manisha, what we have seen is swings both in the currency market and the commodity market for very different reasons. The commodity markets are reacting to what's happened in China, but the currency market back home is reacting to the possibility of a breach on the fiscal deficit target.
Well, there was various reasons that led to decline in currencies and commodities, but starting with the rupee, we did see a 6-month lows of 65.15 at one point in time, but by the closing there was recovery. The recovery, of course, came in because of likely dollar sales coming in from the RBI, and also there was dollar sales from the bankers and exporters, and that gave some support for the rupee, and that's the reason you saw closing coming in on the higher side. But in the short term, there are various reasons, micro and macro, which will perhaps continue to keep the currency markets volatile. The biggest, as you mentioned, of course, is the widening fiscal deficit. That, of course, was the trigger today. Apart from that, it also had to do with the weaker numbers in sense of economic data in India. So whether it is the GDP numbers, IIP, inflation, markets have a keen eye on all of that. Apart from that, it also was the sell-off in the equity markets. The FIs have been net sellers for a second straight day today in the Indian markets, and that pulled the rupee on the lower side as well. You also are looking at the global market cues, where you have seen the Asian markets currencies continue to decline. That took the rupee down with it, and the Fed rate hike expectation before 2017 ends is yet another reason that we saw strength in US dollar and the decline in the Indian rupee. So the expectation really is that 63.5 to 65.5 could be the range for the rupee going forward for rest of 2017. So while the currency markets were slightly lucky, no such case is what you saw in the metal space, which were completely hammered down. This week actually is going down quite negative for all of them. Starting with iron ore to aluminum prices, it has been a decline between 2 to 12% on the lower side is how we are closing this week for the metals. And there have been various points which really have been putting pressure here as well. The major trigger, of course, came in from the S&P, which cut China's credit rating, and that led to a sharp decline. Remember, China is the major producer and consumer of many of these metals, and any small data and event can move the metals on either sides. Apart from that, it has to be the Fed rate hike expectation in the month of December. That has taken many of the tangible commodities on the lower side. So central bank moves, either whether it is from US, Europe or Asia, is something that would continue to matter to many of these metal prices. North Korea's threat or retort to the US sanctions is yet another thing. If there is a more damage going forward, that would also lead to destruction in the metal demand, and that is what was worrying the markets. And of course, in the recent days, we have seen net long positions at record highs for many of these metals. So some long liquidation, stop losses being triggered is yet another reason that you saw the metal prices declining.
But let me bring Lata back into this conversation now. Lata, what is worrying Mint Street today?
Well, it is this fear that fiscal deficit will be higher than expected. There will be higher market borrowing. You must know that for the past probably 36 months, foreign investors have been extremely heavy on Indian bonds, both G-Secs, where they are limit up, and corporate bonds, because the rupee was strong and India was the best yielding Government of India securities as well as corporate bonds. Now, those who must have entered at rupee at 63 or 63.50 and bonds at 6.5% suddenly find themselves completely out of the money when you look at rupee at 65 and bonds at, a 6.7% yield. So it's that money that ran away, the last bit of money, and so the pendulum swung. People were completely unhedged on the currency, hedge funds like these, as well as bond buyers. And therefore you saw that panic retreat when the yield went from 6.6 to 6.69%. I mean, they lost everything that they could have made and more, and so they cut losses. but it appears that, it will stabilize around the 64.50, 65 mark. Further losses are not expected. This is just knee-jerk. It's not as if fiscal deficit has been increased. So I guess, the Reserve Bank also has been happy with the rupee at 65. At 63.50, they were constantly supplying dollars, and therefore now, it's just a new normal for the rupee. It's likely to be between 64 and 65. I think it's a day's panic, unless now there's actual market borrowing increase. And on September 28th, the second half borrowing calendar will be announced by the government. Unless market borrowing is actually increased, I think this panic will just ebb away.